Hello everyone. We are Ding, Patricia and Stephanie. Let's enjoy our video presentation. Summary of the audit process. Phase I: plan and design an audit approach. Phase II: perform tests of controls and substantive tests of transactions. Phase III: perform analytical procedures and tests of details of balances. Phase IV: complete the audit and issue an audit report. For this topic we will more focus on Phase IV: completing the audit and issue an audit report. Definition of subsequent events are events occurring after period end and the date of the auditor's report, and facts discovered after the date of the auditor's report. Auditor should consider the effect of subsequent event on the financial statement and on the auditor's report. Under subsequent event also, management of the entity has the responsibility for establishing policies and procedures to identify and account for subsequent events. Auditor should review the management's procedures to identify subsequent events and perform specific audit procedures designed to identify subsequent events. When auditor becomes aware of subsequent events which are material to the financial statements, the auditor should determine whether they have been properly accounted for or disclosed in the financial statements. This diagram is represent of the subsequent events period for earthware clothiers. The period from the date of the financial statements, the 30th of June 2017, to the date of the auditor's report, the 1st of August 2017, is sometimes referred to as the formal subsequent events period. During this time frame, auditor actively conducts audit procedure. On the period from the date of the audit report, the 1st of August 2017, to the date of issuance of the financial statements, the 15th of August 2017. The date the financial statements are issued is the date that the financial statement and audit report available to the third parties. In this situation where a fact becomes known to auditor at the date of the audit report, may cause the auditor to amend the audit report. Period 1. From year end, during the field work but before signing audit report. Auditors have a responsibility to perform procedure to discover and evaluate all subsequent events that may have a material effect on the financial statements. Auditors also should make necessary adjustment or disclose in the financial statement. Period 2, from signing date to delivery of financial statement. Management are responsible to inform auditors of facts may affect the financial statement. If the auditor becomes aware of a fact which materially affect, the auditor should consider whether the financial statement need amendment, need to discuss with management and appropriate action should be taken. When management amends the financial statement, auditor need perform additional audit procedures and dated the financial statement with a new date. If management do not agree to amend the financial statement in situation where auditor believe they need to be amended, auditor should express qualified opinion or adverse opinion. Period 3, after delivery the report. Auditors have no responsibility to perform audit procedures. If the auditor becomes aware of a fact which materially affect, the auditor need to consider whether the financial statement need revision, should discuss with management and should take appropriate action. There are two types of subsequent events. First, non-adjusting event. Second, adjusting event. Non-adjusting events refer to conditions that did not exist at the balance sheet date but exist subsequent to that date. If material, need to be disclosed in the notes to the accounts. For example, purchase or disposal of a major business or subsidiary by the entity and issue of shares or bonds by the entity. Adjusting events is an events that affect the financial position and the financial statement on balance sheet date need to account for the events. As an example, the bankruptcy of a customer that occurs after the balance sheet date usually confirms that a loss existed at the balance sheet date on a trade receivable and the entity needs to adjust. Audit procedure for subsequent event include 1. Obtain an understanding of procedures management has established to ensure subsequent event are identified. 2. Inquire of management. 3. Read minutes of meetings of entities owners, management and those charged with governance. 4. Review budget, cash flow forecasts and their management report. 5. Examine the books of original entry, sales journal, purchases journal for subsequent events period and investigate unusual transactions. 6. Inquiring to lawyers, asking legal counsel about any litigation, claims and assessments against the entity. Contingent liabilities defines as a potential future obligation to an outside party for an unknown amount arising from activities that have already taken place. There will be a risk that it will not be completely and properly disclosed. Examples of contingencies include 1. Product warranties or defects. 2. Guarantees of obligation to others, example, corporate guarantee given to lenders for loans to another party. 3. Pending or threatened litigation, example, pending litigation or court cases and option to purchase. Audit procedure for finding contingencies. A. Reading the minutes of meetings of those charged with governance such as Board of Directors and Audit Committee. B. Reviewing contracts, loan agreements, leases and correspondence. C. Reviewing tax returns, tax liability and tax authority report. D. Inspecting other documents for possible guarantees. Litigation issues is about make appropriate inquiries about litigation and claims is an important part of completing the audit. These matters may have a material effect on the financial statements and thus required to be disclosed in the financial statements. Example of type of litigation are 1. Breach of contract. 2. Patent infringement. 3. Violation of government laws and regulation. Legal confirmation letter defines as a request for confirmation lawyers for identification of litigation cases. A legal confirmation letter sent by the management to the lawyers to provide the auditor with the following information. I. A list of claims or actions against the company. 2. A list of actions brought by the company. 3. A list of threatened and impending litigation and contingent liabilities. Commitments defines as an agreement to commit the entity to a set of fixed conditions in the future, regardless of what happens to profits or the economy as a whole. Often enter into long-term contractual commitments to acquire capital assets such as plant and machinery, to purchase raw material or to sell their products at a fixed price. Long-term commitments are usually identified through inquiry of management and other entity personnel during the audit of the revenue and purchasing processes. Accounting standards on derivatives and hedging require such commitments are disclosed in the notes to the